welcome back. You're watching The Money Show, and it's time to move on to our next topic, which is risk involved in mutual funds. I'm joined by Shweta Rajani. Shweta, all right, so how do we evaluate the risk associated with our mutual fund schemes?
This is very important because we only look at return most of the times, and risk is the other part of the coin. I would just say one simple measure to evaluate risk, which is available, is it's called a standard deviation. Standard deviation, if I just have to explain it very simply, let's say you've invested in a fund for 5 years, but you've made a 14% annualized return. It's not an FD. So it's not that every year you've made 14%. Some years you may have made 10%, some years you may have made 18%. So this variation of 4% from the CAGR of 14 that you're seeing is called as standard deviation. For a layman investor, higher the standard deviation, it means more risk. So this is one very simple risk measure, publicly available, can be seen in fact sheets, which one should look at to see whether the fund that you're investing in is high risk or low risk compared to the peers in the category.
All right, Shweta, we will discuss more on this, but then let's also start taking our viewer queries, and we'll again come back to this topic of discussion. Okay, do we have any? Okay, so let's take Anupurna's question. And this question is by email, and she says that she's presently having SIPs going on in Aditya Birla Sun Life Digital Fund, multi-asset fund. And she also has SBI Contra, HDFC Large and Mid Cap, ICICI Pros Technology Fund, 1,000 in each fund. And she wants to continue investing for a longer period of time. And how is the fund mix? Is what is her question.
So Anupurna, coming to your fund mix, most of the funds are good, but what I noticed was you have a lot of, you have two sector funds, you have a multi-asset allocation fund. This is something that can be avoided because investing in a sector fund needs a lot of timing. If you're not doing this full time, then please avoid these, go in for a diversified fund. So exit from Aditya Birla Digital, exit from the ICICI Technology and the Aditya Birla Asset Allocator Fund. Instead, what you can look at for your portfolio is ICICI Pru dividend yield. Go in for an Invesco small cap, a quant active fund. That would be my recommendation for you.
Let's move on and okay, let's take Vijay's question, Shweta, and he says that he wants to start investing in 3 mutual funds for 5 years, and he wants to know where he can park money for good returns, and 15 to 30,000 per month is what he's looking at, and he also wants to know what is a multi-cap fund, what is HDFC Advantage Fund, Balance Advantage, and whether these funds are good for lump sum investment. The amount is almost 5 lakh that he's looking for.
Coming to what is a multi-cap fund, basically a multi-cap fund is a fund which will have at least 25% of its money invested in, let's say, large cap stocks, which are the top 100 companies by size. The next 25% gets invested in what we call as mid-cap stocks. That's, the next 150 companies by size. And the rest, the next 25% gets invested in small cap stocks. So, companies which are 250 first and below. 25% is a flexibility to the fund manager to invest wherever he wants. Because you're investing in all 3 available market caps, it's called as a multi-cap fund. It's a good category to have in your portfolio. The second one you asked is what's a balance advantage fund? A balance advantage fund is a fund which will have both equity and debt in the portfolio. The proportion of equity and debt depends on what the fund manager's view is on these asset classes. So these allocations towards equity and debt could keep changing. I would suggest you avoid a balance advantage fund because, a fund manager may be investing 60 in equity, 40 in debt, whereas you may want to maintain a 70 in equity, 30 in debt because that suits your risk tolerance. So given your risk appetite and your risk return objective may be different than the fund managers, a hybrid fund is avoidable. The last part you asked is 3 funds. I would say 3 will make it too concentrated. At least look at having, 4 to 5 funds in your portfolio to start with. Few funds that you can consider, I would say an ICICI Pru Focus Equity, Go in for an HDFC small cap fund, go in for a Kotak multi-cap, DSP equity opportunities. Start with this, go on adding later.
All right, let's take Gaurang's question, Shweta. And he wants to invest for next 5 to 6 months, and the amount that he's looking at parking for 5 to 6 months is almost 2 lakhs.
Gaurang, since you're looking at a short-term period, now you have two options. You can either go in for debt funds like a short-term fund, ultra-short duration fund, money market fund, or you can go in for an arbitrage fund. Arbitrage fund is also debt-like when it comes to the risk. It gives you an tax advantage. So if you're in a 30% bracket, then an arbitrage fund would be more beneficial for you. Therefore, the two funds I suggest for you is an SBI arbitrage and a Kotak arbitrage for this horizon that you have.
All right, so that's a recommendation coming up for Gaurang. And with that, it's a wrap on the show as well. Shweta, thank you so much for taking time out and helping our viewers with their financial portfolio queries and every aspect of their financial planning. I'm going to leave our viewers with our WhatsApp number and email ID where they can send across their questions in case any guidance needed. Thank you so much for watching. Goodbye.